Okay, so what sets EganStreet apart? I think let's talk about revenue and let's talk about gold price and let's talk about what it means in a grams per tonne basis. So 1 gram today is worth about $55 a tonne. So if you have a 1 gram per tonne ore body, you get $50 for every tonne of ore that you grab out of the mine, put it through the process plant, turn it into a gold bullion, and then generate revenue. 1 pineapple. Rothsay, 9 grams per tonne. So that means, I don't even know what we call these. I think drug dealers tend to use them. But 1, 2, 3, 4, 5. So for every tonne of ore that we take out of that Rothsay gold deposit that EganStreet has, $500 worth of revenue. So if we want to talk about something that sets others apart, you want to be running a business that can make cash. And that's certainly what we are really keen to do, and that's the Rothsay Gold Project. And that's why we're setting off going from grey to green. Green $100 notes is where we want to be. So let's talk about where we are. We're 48 minutes flight from Perth, 4 hours by car, about 300 kilometres north-northeast. It's a fantastic jurisdiction. It's Western Australia, one of the best jurisdictions to be mining. It's safe, it's ethical, and there is low sovereign risk. So our tenements, we have about 56 square kilometres. They're effectively royalty-free other than the state royalties. They're 100% owned by EganStreet. The area was last mined 25 years ago, and as a result, we already have a portal and an underground mine to 142 metres below surface. So it makes for certainly a low-cost startup. So, you effectively know where we are. I've told you why I think we're pretty good value. Now I want to talk about the exploration potential. So, 3 things I want to talk about here. One is the historic underground mines that are already existing on our tenement. 2 is a ground magnetic image that we took last year and what we believe that means for those historic underground mines. And thirdly, talk about drill density. How many drill holes have actually been put into this mining tenement package? So the first point is the underground mines. The picture that's there, each white dot is an underground mine. They're 100 years old, they're typically 100 feet deep, and they stretch over 6 kilometres. So 6 Ks worth of old timers 100 years ago were mining down to 100 feet by hand. You don't do that unless you actually can pay your bills and make a little bit of money. What's interesting though, is when we then put the mag image over the top of that, we tend to find that all of these white dots are sitting on a contact of an ultramafic unit. So this magnetic image is showing 3 parallel ultramafic units, and these white dots sit either on the footwall, on the underside of the ultramafic unit, or on the hanging wall on the top side of the ultramafic unit. So straight away, we know there's 6 kilometres worth of mining from the old timers. We then do a ground magnetic image and it says, well, there's actually 14 kilometres worth of contact. So that's the same as driving from here all the way to the beach on the Gold Coast and back again. That's 14 Ks worth of potential. The old timers mined over 6 Ks. So the next thing I want to talk about is drill density. Now, our resource is the little red rectangle in the bottom right-hand corner of this image. This is where we've been drilling. There's 400,000 ounces there, and it's 9 grams per tonne. Bottom right-hand part of the image. Takes about 1.5 to 2 kilometres of that strike. Interestingly, the other area is partially drilled. It's very lightly drilled, and what drilling has been done is shallow. It's 0 to 25 metres, 25 to 50 metres. We're still finding gold 400 metres below the surface in our resource area. So with this potential 14 Ks, just a couple of hits that we've had in the past. So to the south, right at the bottom of the image, underneath the red rectangle, so outside of the mineral resource estimate, 2 metres at 22 grams, 1 metre at 53 grams, 3 metres at 56 grams. Then if we go to the north, all the way to the top of the image, we're now talking about 3 metres at 17 grams, 4 metres at 4 grams, 2 metres at 7 grams per tonne. And then in the middle of this tenement package, a few more intersections, 2 metres at 14, 1 metre at 22, 3 metres at 5 grams per tonne. And then a recent hole, 1 metre at 8 grams, but interestingly, that's 240 metres below surface. So these 14 kilometres worth of contact are yielding results, and they're yielding them down at 240 metres below surface. So we believe there's tremendous exploration potential to go forward and a lot of unfinished business. We have some results pending in the next couple of weeks, We're fully funded with our drill programs, and we will be drilling this tenement package going forward as we move into development. Okay, so talk quickly on corporate stuff. Headley sort of stole a little bit of my thunder before, but if you go onto the Line Selection website and you read their website, they have this really nice quote about their investment mandate. And they talk about their investment mandate being the global universe of listed and unlisted opportunities. They have 17% of EganStreet. Two other points I'd like to make on this is that we have 130 million shares on issue. We're a tightly held stock. Our major shareholders are certainly supportive to see us into development and then into production. The other point is we have $12.5 million cash in the bank. Okay? So we're well funded. I'll start talking about the DFS in a little bit, but we believe the funding hurdle for that DFS is about $40 million to take this thing into production. We have $12 million in cash. We are a gold project in Western Australia, and we will be able to attract bank debt. So on a 70-30 debt equity ratio, we can certainly put that equity towards funding our way into the project. So what I'm saying is, as a shareholder, because I'm one, I'm not interested in significantly diluting, or if diluting my investment at all, to see this thing into production. So if you put your money into EganStreet and you buy a percentage in the company, when we're actually producing, that percentage is going to be largely the same. Okay, covered the corporate, covered the fantastic exploration potential. Now I want to start counting down to the DFS. There's 3 points I'd like to talk about with the DFS. That's the growth in mine scale from the pre-feasibility study, then the use of an ore sorter to maintain and even minimise our capital costs as we go into production, and then touch quickly on where the ounces are coming from that are going to feed into this production target. So let's first talk about scale. In the pre-feasibility study, we had effectively a production target of 900,000 tonnes at 7 grams per tonne. Back then, the mineral resource estimate was 700,000 tonnes for 260,000 ounces. Today, the mineral resource estimate is 1.4 million tonnes and over 400,000 ounces. So what does that mean from a scale perspective? Well, it means that we can put bigger ore drives in and go for bigger scale. So put simply, in the pre-feasibility study, we had a small 151 Toro loader. It weighed about 9 tonnes, and each bucket of material, 3.5 tonnes worth of material. Today, with the DFS, with the growth in that resource, we're now looking at a 4.2 by 4.5 metre wide ore drive. So what does that actually mean? It means we put a Caterpillar loader, 1700G, it weighs 39 tonnes, and each bucket now holds 12.5 tonnes. So you go from a 3.5 tonne loading capacity machine to a 12.5 tonne loading capacity machine. Significant increase in scale. Also, when you're developing these ore drives, you go from a single boom jumbo to a twin boom jumbo. You go from a small long hole drill rig to a larger long hole drill rig. They drill faster, they drill more accurately. Significant increases in scale. Your costs come down. In the pre-feasibility, we actually disclosed a mining cost of $146 a tonne. Now, from a DFS perspective, we're obviously yet to release, but we've obviously priced with our contractors. The contracting costs are coming in at $85 a tonne, 146 to 85. Bigger scale means you get to go faster and you get to go cheaper. So now the mine is bigger, faster, cheaper, all the things that certainly excite me. Now we end up with a lot more ore. So what are we going to do with that ore? This is where the ore sorter comes in. We've been doing quite a bit of test work. This unit here is actually housed in Sydney. We've already trucked 10 tonnes of material to that machine, and we put that through late April, early May, and we'll be looking to release those results in the next couple of weeks. But we've tested it before. We've tested it on core. So the technology that this uses is an X-ray transmission, so XRT, no different to the technology that you would be exposed to when you put your luggage through a luggage scanner at the airport. It's as simple as that. So the way it works from our perspective is it separates material on atomic density. So if any of you guys can remember your periodic table, in the middle of the periodic table you have iron, Fe, it has an atomic weight of 55. Up to the top you have silicon, has an atomic weight of 28. So it sees a very big difference between 55 and 28. And so what the XRT sees and what we see looks like this. The image to the left of screen is what we see. Dark grey mafic and ultramafic rocks, light gold-bearing quartz rocks above it. And then what the sensor sees is a pink hue for the light material and a dark blue hue for the dark material. This is chalk and cheese, this is night and day, this is light from heavy. And I've got a really exciting video, but it's on my iPhone, so if anyone wants to see how this actually works when it's doing 33 tonnes an hour, come and see us in the booth. I'm just not clever enough to put into a PowerPoint presentation. But a couple of things to understand. When we put some test work results out early May, we were recovering 22% of the mass. So you put 100 tonnes of rocks in, you get 22 tonnes of rocks out. You put 2 grams in, you get 7 grams per tonne out. So a 3.5 times uplift, and you're only recovering 22% of the mass. So that allows us to go balls out in the underground mine, but then maintain a process plant of 200,000 tonnes per annum. And that fits with the scale that we had in the pre-feasibility. Okay, the third point on the DFS is where are these ounces coming from? I don't want to talk too much about cross sections and long sections because I'm a metallurgist and they tend to bore me, which is why there's no drill traces or any of those things. But a simple thing to understand is on the left is the cross section, on the right is the long projection. So this is the main part of the ore body. It's 300,000 ounces and it's 11 grams per tonne. Now I'm just going to put another layer on. So this is Woodley's East and it came in with the new resource estimate in May of this year. The thing to note is in the cross section, it's 50 metres away in the hanging wall. Woodley's 50 metres above it and horizontally, Woodley's East. 50 metres worth of horizontal development when you're underground is a very cheap, cost-effective way to access an ore body. You're paying about $2,000 a metre for horizontal development. So that's 350,000 tonnes, 78,000 ounces, and it's 50 metres away from the underground development that we're already proposing for Woodley's. Then, you add another hanging wall load. This thing is 10 to 20 metres away. $2,000 worth of access per metre is what it costs you, and it's 10 to 20 metres away. So you're into that for no money at all. Now, whilst that's only 4 grams per tonne, it's new and it's just come into this mineral resource estimate. So as part of the definitive feasibility study, if it makes money, we'll go out and mine it and we'll include it in the production target. So all of these ounces are basically in a location where you can access them from one underground mine. So if you're going to find gold, you want to be finding it in an area where you can actually turn it into revenue. What this does is this provides for multiple headings underground, which gives us fantastic operational flexibility. And as I spoke about, where you want to find gold is areas where you can actually go out and mine it. So we've been finding them in parallel lodes, we've been finding them along strike, and as soon as we get underground, we'll continue to drill out at depth and we'll continue to find it at depth. So in closing, as we count down to the DFS, and as we count down on this journey from grey to green, remember these $100 bills, lots of them. We'd certainly like you guys to consider EganStreet as a component of your portfolio. We're high grade, we're low cost, and we won't be diluting our shareholders as we move from pre-development into production. So look forward to seeing you guys joining us on the register. Thanks very much.